We wanted to start off with sort of where we were to where we are, right? We're giving you sort of a general history of how these rules came about. And have any of you actually had fun trying to read this draft legislation with these rules? It's only 15 pages, but incredibly dense. Does anyone actually try to read this besides myself? You're looking at it now and you say, oh, geez, this is crazy. These rules are complicated. Well, I look at this and saying, if it weren't for the public outcry that arose from July 18, 2017, which we in the tax community call the Morneau Massacre, right? That's what we call that day. Like, you know, it's one of those days that everyone knows, the day that JFK got shot. Whoever was around, remember that day? The day that Paul Henderson scored the winning goal against the Russians. You know that day. This is, you know, where Meghan and Harry got married. We were up at 5:30 in the morning eating English crumpets. You remember that day? You remember July 18, 2017. So we're going to start from where the history came and what ended up happening, what they were actually considering proposing, to where we are now with the two technical rules, which we're going to talk about changes to the RDTOH account and the new passive income rules. Investment income, your active income, all that you're doing. So now, as you were saying, we have an expression called AII, adjust aggregate investment income. We're now introducing a concept to calculate the passive income rules, which is the other grind, to AAI. Adjusted aggregate investment income. That's it. We're adding an A in front of what you already know. Now, don't ask me what schedule is going to be on. We don't know. Okay, that's the first thing all accounts ask me. Where's the schedule? We don't know the schedule. Okay, but that is really all this is. It's just another way to grind your passive income, right? And that's all we're trying to do. So what we're going to try to explain is some basically vanilla structures on how to get around these passive income rules, right? And the question you're going to ask yourself is two questions. Number one, is the small business deduction worth the hassle? Because all this is doing is trying to get rid of your small business deduction another way, right? You got the SBD rules. You got these rules. You got all these crazy rules. Quebec has a rule that if you have more, unless you have 5,500 employment hours, you don't get the SBD. So they're attacking professionals. And guess what? Everyone's saying, Quebec, that crazy place that Manu's from. Why the hell do we care about Quebec? Well, where do you think the rest of Canada gets their draft legislation from? Quebec. Right? The more socialist policies come from Quebec. So guess what? A lot of people are fearing, the OMA is fearing, that the federal government's going to adopt the Quebec rule for physicians. Right? So the question becomes twofold. Number one, is the SBD worth it? Right? Is it worth it? That's sort of the only ending question we have today. And I'm going to ask you, is the SBD worth it? Should we get rid of it? Let's talk about passive income proposals where we were. So, in the budget of 2017, which was in March, I believe, they basically said they were going to look at the fact they didn't like the deferral aspect, right? And they felt that the federal government said that, well, we were concerned about large amounts of funds were being shielded from taxes inside of corporations, which is what we learned is being deferral opportunity, right? That's what we were doing. And why did this come up? Why were they concerned about this? Because there was a proliferation of corporations. Why were there a proliferation of corporations in the last, let's say, 8 to 10 years? From where? From where? PCs. What was the reason why PCs were allowed to incorporate? Who were the first ones that were allowed to incorporate here in Ontario? Why were the doctors allowed? Now, this really upsets my wife for two reasons. Number one, my wife, she was like to me, oh, Manu, I got it. This is in 2004. We got to incorporate. I'm like, yeah, you'll be the one. Don't worry, you'll be one of the first ones. She was number 4 in Ontario ever to be incorporated. She wanted to be number 1. She goes, I was number 1 in elementary school, number 1 in high school, number 1 in med school, and you gave me number 4. I was off the medal podium. That was number 1, what she said. She was upset. So the second reason now, when you raise this temperature, why did they allow doctors to incorporate? Because Ontario did not want to increase the OHIP rate. So what they did instead is they said, fine, we're going to let the federal government pay for your increase in salary by benefiting off of lower corporate rates. Right? That's how they got their increase. Right? If they had paid the OHIP rates, this would never have been an issue, and this would not have flagged CRA. Right? So they're sort of like nailing the doctors on both ends here. Right? And then what happened was all the professionals jumped on the bandwagon, because then they said, hey, if the doctors and dentists are allowed to incorporate, why not the accountants? Why not the lawyers? Why not this? Why not that? And all of us got on the bandwagon. And this is presented, what we've been selling to our clients for the last 10 years in Ontario is that, hey, you're now introducing a quasi-RRSP, where it's not perfect RRSP, but what you're doing is you're taking money, instead of being taxed at now current rates of 54%, you incorporate, get taxed at 13.5%, leave $86 in the corporation to invest. So you're basically stuck with enough, you have left with another $40 of extra money that you don't need to take out. They didn't like that, right? So now there's other benefits, right? That you have deferral beyond investing for personal retirement. There could be diversification, economic support, keeping up with inflation, access to financing. You know, there's a whole bunch of reasons why you want to defer. There's other deferral and tax opportunities besides incorporating. There's RSPs, there's RIFs, there's all these TIFSAs, there's all these things that we're talking about here. And the idea was, remember when Morneau said, he goes, hey, the average Joe has no option, has no access to incorporating. So you're getting an unfair advantage, whoever's incorporating, to the average Joe. So what we want to do is increase the tax rate and collapse the deferral inside your corporation, which we're going to see some rates, right? We're going to look at some numbers, you're going to see some rates. Remember, this is jogging your memory a little bit. And remember at the time in July 18th, what was announced on July 18th? Was there actual law announced on this? No, there wasn't. There was this crazy position paper written by some guy who I'm not going to mention his name, but he's a guy at the University of Ottawa, and he came some crazy position paper, which we're going to get into what he's talking about. So what happens is there's risk and rewards. You have elimination of major incentives of small businesses and entrepreneurs. Should the government, so the issue was, should the government offer incentives through the tax system? These are just policy questions. Should they offer deferral? That's an incentive. Should that be like a subsidization through the tax system? Should businesses share in the rewards of the government? Employer versus employee risk. Well, the aspect is, again, we were looking at this, is that if there's an employer, shouldn't he get the benefit of this deferral because he's getting all the risk? Shouldn't he get the reward? Which is a major issue when you're comparing to an employee, because employees don't have that same risk that the business can go belly under. Nothing wrong with it, but there's a risk and reward faction too. So too much burden. The question is also, the deferral aspect is so important because there's a lot of tax burdens being put on businesses. The increase in the federal tax rate from 29 to 33%, right, on the personal side. New intercorporate dividends rules, safe income, small business deduction, pending CPP increases, minimum wage hikes. This is just all the policy that this is hitting all the business owners all at once. Right? Shouldn't they get a break? This is, again, the thinking behind what the rules were. So here's, again, what we're looking at, that this is the current rate right now on ineligible dividends if you do a flow-through. Okay? On ineligible dividends, your effective rate is 57.96%, and effective integration, if you get the income directly, is 53.5%, so we're 4%, under-integrated. We're 4% cost. What Morneau was proposing was getting rid of this refundable tax here and here. So eligible dividends would have cost you 69.77%, and this one would have cost you 74%. Fair, isn't it? I'm just explaining. Like, it didn't happen. Don't worry. Now, people are freaking out, saying, "Oh my God, this is what's happening." No, 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 no. This is what he was proposing. Those two on the right, right? And you can appreciate the individual here is at 53. So what he was trying to do is collapse the deferral here. So here we talked about this. He goes, once a new approach is determined, the tax treatment of passive income, the government consider how to ensure that the rules have limited impacts. Okay, this is the grandfathering. We know that's out the window. Here we talked about a $50,000 threshold. Okay? The problem now with Morneau is we're going to see there was another way to have dealt with this issue. The problem was you can't have, it doesn't make sense to be able to clear out RD2H generated from non-GRIP assets, non-GRIP income by eligible dividends. We're going to talk about there's another way he could have done it. But he was stuck with this $50,000 threshold, so he had to introduce this limit. Okay? We're going to explain this is sort of where he was stuck with. Okay? So he also has to put in place, and investors are in place so that Canada's venture capital and angel investors can continue to invest in the next generation of Canadian innovation, which we're going to look at. He does put something in there. Changes to the RD2H account. So perfect timing. We have this little brief drive-by. Do we have an understanding? I don't expect you to remember all this, but do we understand where we're coming from? Okay? And you're going to see these rules now that are coming out are more specific. Okay? ERD-TO, NERD-TO, they're specific. This one is going to be more applicable to you guys. Okay? It'll be more applicable to you guys. The passive rules, I would say less than 1% of your client base will be affected by them, in my opinion. Because you're only going to get it if you get AA at 50,000 bucks. AA, not the active income, AA. So always think AA, look at Schedule 7, it's Schedule 7 modified. It's the investment income in Schedule 7 modified. Okay? So, at present, the refundable tax is refunded to a corp at the rate of 38 1/3 for every $100 in taxable dividends paid out by the corporation to shareholders. We've discussed this. Can you clear the RD2H with eligible or ineligible dividends right now? Do we care? You thought that was a good deal, eh? I know probably you'll say, this is great planning. You know, we can build up eligible our GRIP. So what you need to have is GRIP in the company, and you need to have RD2H. Which schedule does Holdco have? Does either company have 53 and 7? Is each company have 53 and 7? So conceptually speaking, the Holdco has what GRIP? Sorry, what RD2H? Bad. It is bad RD2H. Because you don't have in the same company as of December 31st, 53 and 7. You have to have one company. Now one smart accountant will say to me, hey, on a consolidated basis, we have everything. Do we file consolidated returns in Canada? Are you sure? I had one accountant trying to force a consolidate. He was from the US. He came to Canada. He goes, how come you guys, I can't get your consolidated return to work here in Canada? I'm like, it doesn't work here in Canada. That's why you don't have it. So what do you do? What do you do in order, if you have this situation now, what did I tell you? You need to have, for good RDTOH, pay the grip up. That's one example. See, I told you all readers are smart. Pay the grip up from OpCo to HoldCo before December 31st, 18. So in HoldCo, you then have the lesser of 38 1/3% of grip and the RDTOH. Now what we're going to do is pay a dividend up and loan it back. This is what the net after-tax cash flow is. You're saving $110,000, which is the difference between $791 after tax minus $681 after tax, which is resulting in what's the number? 7%. So how many of these clients you're practically going to do it for? You're not going to do it for every Tom, Dick, and Harry that has, like you're saying, Paul, you have consolidated groups. You're going to look at it to say that I would look at this for any type of planning, in my humble opinion. You need to have a 6-figure saving after the fees to do it, to sell it to the client. Because if you're having I don't know if you agree with me, if you have a 5-figure saving and it's going to cost you 5 figures for fees, it doesn't sell as well. If you're going to take a 6-figure saving and you're going to net the fees off again, this will be good. But it's going to be some clients. It's not all of them, but you're dealing with larger groups. So now let's look at the passive rules, which is not as, like you're going to see, it's very specific. And what we're going to do is we look at the planning here, think of this and relate this back to RDTOH. Okay, because if I get rid of investment income, I'm potentially getting rid of RDTOH, except in one strategy you're going to see. Okay? So the 2018 budget proposed to reduce the business limit for CCPCs and their associated companies that have significant income from passive investments. Measure proposes the business limit will be reduced on a straight line basis for CCPCs having between $50,000 to $550,000 in passive income in the current year. I looked at that, Leanne, very carefully yesterday. It does not say in the prior year. I can show you the legislation if you want. It says it says in the taxation year. If you look at the other one for LCT, it says in previous year. We're going to actually go through that here. So what is it? Is it an asset used by Canadian controlled private corporation, principally in an active business of a corporation? So basically meaning principally. So a rental property, Ron's example. If he has less than 5 full-time employees, does that count? No, it doesn't. So now what are you going to try to do when I have a rental building that I want to sell? What are you going to try to do when you sell it? You're going to try to get more than 5 full-time employees to make it active, to get it out of the passive rules. It never works. You've tried it?
No, but
it's practically not possible, yes. You would consider it, though. You'd consider it. That's how I use my money. I say consider this, consider that, consider this, right? But yes, I'm just saying that's how you get out of it. Okay? Or it's used, but let's say you have an OpCo-RealCo scenario. That's okay because it's used by an active, and that's typical creditor proofing. Remember the dirty word? That's okay because it's principally used in an active business by a related company. That would count. So that's okay because that's what you typically use. You never have a building hardly in an operating business. So this is what we're talking about here. There's another anti-avoidance rule that says if I have passive assets, this 150 to 150 is on a related group or an associated group? Associated group. So there's an example. Let's say my brother and I have a company, and I have an associated group of company. I transfer an asset to my brother's company that's passive. For the purpose of avoiding these rules, because I'm saying, oh, my brother's company is related to me, it's not included in this calculation. If one of the reasons for me doing this was to reduce my AA, we're deemed to be associated. So if you're doing butterflies and stuff and transfer of assets, you better have another non-tax reason for doing it, just not doing these rules. Now, I'm doing a plan like this right now, but we have a bunch of estate planning reasons to do it. So we got to let the client know, look, there's a risk, but we're going to say there's other reasons. We're not mentioning AA in our planning letter to avoid this rule. Okay, so this is an interesting thing. So a lot of people are saying that the small business deduction needs to be removed or curtailed or rethought. That's what I'm getting the impression, is that the understanding is going to be thought, because also from a practical perspective, how are we going to recover the time for all this stuff? How are we going to get paid for this on a reasonable basis where clients are already, yeah, I don't think most of our clients say, forget it, it's your problem. You know? So the last question is now, and this is a food for thought, do we view the small business deduction as an entitlement which is what it was before, or something we have to qualify, because this is what it's almost becoming, is that we got to qualify for it now. It's almost like a credit. It's like a disability credit, right? It's like an R&D credit. Philosophical school of thought. I'm going to leave you there.